Credit card rewards feel like free money, but economically they are a redistribution machine. The trick is that the person receiving the reward is not always the person funding it. Start with a $100 purchase. The customer sees $100. The merchant does not keep $100. If the sale runs through a credit card, the merchant may pay a merchant discount rate around 2 to 3%, sometimes more depending on card type, risk, and pricing contract. That fee is split across the system, the issuing bank, the card network, the processor, the acquirer, fraud costs, chargeback risk, and compliance overhead. The largest piece is usually interchange, which is the transfer fee flowing toward the bank that issued your card. Now compare that with a 2% cashback reward. On a $100 purchase, you get $2. But if the merchant paid about $2.60 to accept the card, the reward is not magic. It is a slice of the payment toll coming back to the cardholder. The merchant pays the toll first. Then, over time, the merchant has to decide whether to absorb it, raise prices, set card minimums, surcharge, or push customers toward cheaper payment methods. This is where the economics get uncomfortable. If most customers pay by card, the fee becomes part of the store's normal cost structure, like rent, labor, spoilage, or electricity. Prices rise for everyone, including cash customers and debit customers. But the reward only goes to the card user. That means a household using cash can help fund the rewards of a household using a premium card, even if both pay the same shelf price. Not all cards cost merchants the same. A regulated debit transaction in the United States has a federal cap for covered issuers, 21 cents plus 5 basis points of the transaction, with a possible 1 cent fraud prevention adjustment. A premium rewards credit card can cost far more because credit card interchange is generally not capped the same way. That is why a basic card, a rewards card, a premium travel card, and a business card can create very different economics for the same merchant selling the same product. The issuer's business model is broader than one transaction. Banks earn interchange when you spend, annual fees from some cards, interest from customers who revolve balances, late or penalty fees where allowed, and sometimes partner revenue from travel portals and retailers. Against that, they pay rewards, fraud losses, customer service, funding costs, marketing, and credit losses. A customer who pays in full every month may be profitable mainly through interchange and annual fees. A customer who carries debt may be profitable through interest. The portfolio, not the single swipe, is what matters. This is why rewards programs can redistribute benefits in a very specific direction. Research from the Federal Reserve has examined how reward cards can transfer value toward higher credit score, higher spending users and away from lower score or revolving users. The person who maximizes points, pays no interest, and redeems efficiently is playing one game. The person who carries a balance at a high APR is playing a completely different game, even if both cards advertise the same rewards headline. Points make the system even harder to understand. Cash back is simple, $2 is $2. But points and miles are private currencies. Their value depends on redemption rules, partner inventory, blackout dates, portal pricing, transfer ratios, expiration, and future devaluations. Issuers like points because they create flexibility. Some points are never redeemed. Some are redeemed at low value. Some make a customer feel wealthier than they actually are because the reward is separated from the original price paid. So the expert way to judge a rewards card is not, what % do I earn? The expert question is, what is the net value after fees, redemption friction, price effects, and behavior risk? If you spend $12,000 a year and earn 2%, the gross reward is $240. Subtract a $95 annual fee, and used benefits, and 1 month of interest from a carried balance, and the reward can disappear fast. Rewards are real. But they are not free. They are priced into a payment network, and the winner is usually the person who understands the whole network, not just the shiny percentage.